So you're likely going to be doing an observation of an inventory count if you're an external auditor. Doing it internally, you might review the documents from an internal audit perspective, but you want to make sure that you have all the inventory listings and they all tie out to the general ledger balance, because that's how you determine whether if you have all the listings or not. So then you plan for the observation of that inventory count. You make sure that every inventory item that needs to be emphasized is put in that observation. You review cycle count procedures, how they do it, what their process is. Like some places have what's called an ABC method. The A items are the items that get used frequently. They cycle count those more regularly, sometimes daily, sometimes weekly, sometimes monthly. Then you'll have BC items. C items rarely get used, rarely get counted. Of course, those are the ones that I note for my obsolescence review. Determine if specialists are needed, because you could have some sort of special chemical or product or something that you as an auditor may not know how to really figure out the measurements for that. And so sometimes you might bring in a specialist or just ask a specialist some questions related to that. Plan for whether the warehouse or plant will be shut down or is it still operational, because that impacts it. Think about it. If you've got a warehouse that's got 24/7 shipments out to clients and you have to, or to their customers, and you have to go in there and count that inventory, you're trying to pick the time period to observe that when there's the least amount of activity. And even then, because there might be some activity, you've got to factor that activity into your count. So ideally, you shut down, you do the count. That's why you'll see a lot of this happen right at year end. So as much as people are going out to party for their December 31st Happy New Year's, you might be doing an inventory count. So the exciting life of an accountant emphasized by the inventory count. So you're going to observe that inventory count and make sure that the documents related to your work papers are correct with all the items, the counts, the unit of measures. Make sure you've got the right unit of measure on the items that you're looking at. And so then you'll be able to note any obsolete inventory or excessive inventory through that observance, and then you'll develop your conclusions on the audit plan. Let's do a quick review of those costing systems for inventory. You know LIFO and FIFO, and average costing from managerial and cost accounting processes. So LIFO, last in, first out. Sometimes I've heard of it called FISH, first in, still here. Sometimes that's easier for people to understand. Same with LIFO, first in, first out, which can also mean the last in is still here. So you'll also remember average costing, which could be comprised of a weighted average. It could be a perpetual average, but know that some systems are set up to take like the last 5 purchases to figure out their average. So this will depend on what your system can do. But one thing you don't really talk about, as much as in managerial and cost accounting, you talk about standard versus actual. Standard costing systems are how a lot of accounting systems are developed, where once a year you put the new cost for those items out there into the system and it calculates variances the rest of the year based on those costs that you started at the beginning of the year. Now, standards are not really supposed to change much, so they rarely change, but occasionally you come across that situation where there's just a significant variance that's constantly popping up from one particular costing model that was either input wrong or just has had significant changes in pricing and whatnot. So you'll do what's called a cost roll. Cost roll means it's going to roll through all the inventory and re-add it and revalue it. So there's a couple ways that rolls happen, and it's important to understand the procedures and allowable procedures related to this by your company. But you could do a full cost roll where it just goes through every inventory item and revalues it based on the changes, which you could have major items that you're changing, but then you might have made some minor changes. It's going to accept all those and just put them all in and roll the cost up together. So you might have what's called a partial cost roll, where it just takes specific items or specific product groupings and it will just revalue those. So cost roll is probably a term that you haven't heard much, but that's something, if you get into the manufacturing area, you're going to hear quite a bit related to the standards. And then an auditor should obtain the procedures and how that costing system is supposed to work and how it's supposed to be administered, how it's supposed to be updated. And that's important for the auditor to know. And then we're going to test that cost system and then document the results. For substantive tests of accounts payables, the big one is really the cutoffs. Are you recording everything at year-end payables that should be in there? So you're going to examine a sample of disbursements after the year-end, January, February, sometimes even March disbursements, and look at those actual invoices and see, was this really for product from December or November of last year? Should it really have been on accounts payable last year if it wasn't? So that's the search for unrecorded liabilities. You're also going to verify dollar amounts of any large disbursements after the year end to make sure that it really was recorded properly at year end. You could have a large payable that's on there, but then when you look in January and February, maybe it was higher than what they had recorded. So that's a way to manipulate if you've understated your accounts payable. So verifying some of those large payables in the subsequent month of January and February might be a good idea. You ideally would like to compare vendor statements to the year-end balances. So when you look at those statements, does it tie out to your accounts payable listing? If you don't have a vendor statement, and a lot of times people don't, you might request them from key vendors just to verify that what they've recorded is proper. You're going to analyze and review travel and reimbursement expenses. This is on a testing basis, but you're just trying to see if they are going through the proper policies and authorizations to before they expend and pay those travel and reimbursement expenses. You're going to review any old payables that are out there. Make sure they still exist. Because if you see something that they haven't paid in 9 months or a year or whatever, the possibility is it got duplicated in the system. They paid one and the other one's just sitting out there. So that could be a payable that really shouldn't be there. Another thing to think along these lines are it's a significantly large one. They may have converted it to a notes payable, so it's no longer really an accounts payable anymore. So you just might want to verify that. And that will all lead to review management's financial statement disclosures for proper presentation.